Most people really are bearish. In fact, even today, the Boston Consulting Group released their annual investor survey, and it showed that investors were the most bearish since 2009. You know, I think there's a lot of people saying that everybody's bullish simply because the stock market has gone up, and everybody's bullish because they think valuations are too high. The reality is that everybody thinks that, and everybody's scared of the equity market. They think 2008 is about to replay anytime, and we have to protect against that. That's not the way to make money.
Yeah, so what is the way to make money in 2018? Because we like making money.
Well, I think, of course, everybody does. I think the way to do it is follow fundamentals. Look, earnings around the world are still accelerating. Right? Is that going to continue through all of next year? I don't really know, but right now that's the case. It's really hard to get a bear market when earnings are accelerating. We know there's a ton and a half of liquidity out there. Look at something like Bitcoin, right? We know there's that liquidity out there. Very hard to get a bear market when you have a lot of liquidity. There's a lot of ammo for people to buy on the dip. So it's very hard to get a bear market when that happens. And as I just pointed out, sentiment is on our side.
But what can change is an economy that gets a little too hot, a labor market that gets a little too tight, and a Fed that gets a little too aggressive in raising interest rates. Do you worry about that? Maybe not so much for 2018, but as the turn is made into 2019 and beyond.
Well, of course. I mean, we have a reasonably healthy economy, and now we're going to get a tax package on top of that. You know, the tax package isn't meant to slow anything down. It's meant to speed it up. So you're right, Tyler. The risk is that you do get an overheating economy as we go through 2018 to 2019. That's normally called a late cycle environment. Late cycle environments are characterized by more inflation than people think, a Fed that plays catch up, and eventually, the key word there, eventually, inverts the yield curve. That's your warning sign. But even when the Fed inverts the yield curve, you still have 6 to 12 months to reposition your portfolio. It's, you know, it's not like a dimmer switch, and as the curve flattens, expected returns go down.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.